All right, all right, all right. It is time, Johnny Walkup. It is Macro Monday time, Johnny. Are
It's
you
another
all
beautiful
you
day,
ready?
another beautiful Monday in Manhattan
Beautiful,
and Brooklyn.
beautiful Monday in macro land over here. Let's get inundated in charts.
You,
Let's
you know what it
let's nerd
was? It was
out.
a beautiful. It was a beautiful weekend. I mean, I'll tell
It
you
was
that
nice.
straight off. It was. I mean, the weather was absolutely amazing. So I hope everybody had a chance to get out and enjoy it. I certainly did. Noah, I know you
Yeah.
live for real estate data like myself, but I'm sure you
Oh
got out
yeah.
too.
Yeah, I got away from it a little bit, but we're back. We're
We're back.
back, and we're gonna get going really soon. Let's. I'm just waiting a few seconds for some people to get on here, but we're gonna get going, Johnny. Hello, everybody. Thank you guys for joining us so much. We're back for another session of Macro Monday. That is John Walkup. I am Noah Rosenblatt. We are both with Urban Digs, and you guys are gonna get a little Macro Monday coming right to you. For those of you that are new to this show, we're gonna start out with Manhattan real estate. Take a look at those trends. And we're going to take a look at a bunch of macro topics, Sean. Credit spreads, Fed made a move. They made a move. They cut
What?
rates.
The
Unbelievable.
Fed moved? I missed it.
Yes, they did.
I didn't.
They did.
Spoiler alert! I didn't miss it. I saw it.
And rates didn't do what you would have thought they did. Rates didn't. They did something else. But if you watch this show, you are not surprised at all. You knew exactly what was going to happen. Okay. We're going to talk a lot about macro topics, but none of this stuff, guys, is trading advice. Do not. Don't go start day trading this stuff, even though, I don't know, John.
That's
the
one that got away.
If you have this one, you're doing okay. If you got some Corcoran, or I guess it's a whole bunch of companies in this. It's like a conglomerate of sorts, Johnny. But Compass, the news is out. Compass is merging. I think it's merging. Same with House. And that just happened. And look at that. That's like kind of dragging up the sector a little bit. I don't know. Consolidation going on in the industry, John.
Tis the time. Tis the season for consolidation.
Yeah. Interesting stuff going on in the Manhattan real estate world right over there. We just figured to give a shout out to that news that's going on. What do you guys think? Any comments on that, guys?
I feel like we buried the lead on that one. I mean, come on, Compass and Corcoran getting together. I mean, that's pretty huge news, especially if you're dealing in Manhattan real estate. And I'm talking about the weather.
Oh, seriously. Corcoran was rumored to be buying out Elevin a couple months ago, and they gave that stock to that. And now it's like
that was the head fake. Yeah.
Yeah, look over there. We go over here. Crazy stuff going on anyway. I'm curious, you guys, what you guys think. I don't know if you're just finding out about this morning like we are, but interesting stuff. Let's go to Manhattan real estate, guys. Let's look at Manhattan real estate so we can up our game, know our stuff for our clients. 'Tis the season. John, I want to start at the market ticker right over here. 1 month. Manhattan supplies at 1763. We are supposed to end September at 1757. 1757. And all of these, look at all of these late August low inventory pre-Labor Day kind of a thing. That's going out over the next 7 days, and new stuff's coming in. I think we're going to come in high.
Yeah,
from our seasonality.
We're going to be coming in high, but we're not going to be coming in substantially higher. So, I mean, we're still within like the normal range. I mean, we're not coming in on the number. We're going to come in above the number, but not 20% higher, I don't think.
I don't know. Well, I don't know about that. We'll see what happens.
We got what, 8 days left? Basically 5 days left because this week, then it's the weekend. So,
well, you got a lot of this little stuff over here going out, and you got probably bigger stuff coming in over the next 8-9 days. So that's what I'm saying. Don't make me put my British accent on for you. Okay. We'll keep an eye on that. I think it's going to come in high. 1757 is our norm. Okay. Contract signs, that's our deal activity. We're at 655. This is about the time where it bottoms. We're supposed to be at 707. This is our weakest deal activity month. This is our highest new listing month.
September. It is, and that's always the concern with that fall season because it always gets a little topsy-turvy there for a few weeks. And the contract signs in end of September, it can be the dark horse, can come from behind to surprise you, at least on that seasonal number. But right now, it is coming in a little bit light. But listen, I'm telling you, the weather was so great that I hope people are out at open houses on Sunday going like, my God, look at this view, look at this light. Where do I sign? That's what I hope happens.
Right. And we got a comment. We got a comment about the merger. Merger, the big merger, private listings monopoly. Compass, they're the ones that brought this whole private listing thing going on over there. I don't know. Maybe is that what they're thinking? Control all the inventory. I know that's something Robert Refkin said a lot.
I think that is certainly we could have an hour discussion on that topic alone. I've got my feelings. You got your feelings. The market has its feelings. So who knows? Who knows
we'll
what
see.
this feelings
Interesting comment.
On this one.
Okay, let's move on, guys. I want to point out optimal time to list because this is the season, guys. Let's just highlight this right over here. You can see September, by the way. This is our deal activity by calendar month. That's what this is showing you. Contract activity. You can see my little axis right over here, right? March, number 1, May, number 2, April, number 3, June, number 4. So the spring season comprises the top 4. Then you got the fall season. Here we are. So let's understand, as John likes to say, it's a compressed season. It's not 4 months, it's 2 months. As you can see, we are in it. We are at the optimal time to list right now. If you have sellers that are waiting, try to pull that forward. If they're going to list in late October, early November, bring it forward.
But you don't even have 2 months, right? You have October, basically, and then you have pretty much the first half of November. And after that, it's like, wait a second, do I have my turkey? Do I have my stuff? You have other things on your list besides real estate.
Yeah.
So
November's like the first half of November's like that, and then the second half of November, like the last week, is like that. It's like it's tilted that way. So that's what John's trying to say.
It's kind of the same thing. Like once you get past Memorial Day in June, like end of May, early June, you get a couple of weeks where that residual deal activity still filters in, but you don't have that new buyers powering forward the front end of the pipeline. So that deal volume drops off. So you want it on the market now, so you can have that those buyers coming in, doing the due diligence, signing those contracts by end of October, early November.
Yeah. Hit the market now, hit it ahead of the action. And then mid-October is your price reduction conversation to take advantage of that front-loaded November, as John is saying, right? Got to get the deals done before a week or two before Thanksgiving. That's our hope. Okay. All right, good. That is that. Guys, let us know any questions on that. I want to move forward. It is Macro Monday. After all, we're going to go to credit spreads. We're going to pivot. Credit spreads, Johnny. Pivot. This is our canary in the coal mine market signal. Guys, this is not Manhattan. We're talking Wall Street kind of now, the global economic credit machine, credit markets. We're looking at the spread between corporate bond yields, U.S. treasuries. Okay, sometimes that spread widens like that. That's bad. That means this thing is going up. That means this little indicator over here is going to the right. That's the kind of thing that happens in bad times, right? Great financial crisis up there, pandemic over there. You don't want that. Sometimes that spread narrows and comes in. That's what's going on right now. That's a good. It's a more good thing. That means credit stress is going down. That means it's risk on. All right, it's going down, risk on. I don't see any warning signs here. That's why we look at this for a warning sign, so we're not blindsided.
Yeah,
that's it.
This is like doing an inspection on the financial plumbing, and you open up the sink with your little flashlight looking for leaks. Right now, it's all good.
It's all good.
They are drifting down, which I did have my feelings once Liberation Day rolled around and April was just absolutely roiled, and we saw this kind of drift up, but then it started coming back down, and I was very suspicious of that. I've been pretty much roundly proven wrong. I still don't think we're out of the woods. I'm still holding on to some doubt here. However, look, you can't. The market
just gotta let it go.
Irrational longer than you can say solve it at this case. So I just want to let it go. Just let it go.
Hey, and Compass just took out Corcoran. You never know what's going to happen. Like you never know what's going to happen. But you know what, John? It's a very man of you to go say that it didn't work out. But who cares? You know, our calls and our predictions sometimes they don't work out. At the end of the day, we're reading the tape. We're reading the tape and telling you guys what you need to know. This is
but my point is not only that. Look at where they are now and draw that line across, and you can see like they are at lows that we haven't seen in a while. So you know that we've really come down below, and which is bonkers to me, given the uncertainty that we faced April into May. Even today, I still think there's uncertainty out there, but I think the Fed's starting to lean one way. I think we're going to talk about that in a second. And I think that zeitgeist has sort of shifted, and we've been pressed down. So yeah, we're still definitely much higher than we were pre-pandemic. I mean, that was a totally different time. Zero interest rate policy, ZIRP, all that stuff. So we're above that, but we've really, really made a dent in these credit spreads. And basically the idea is that the confidence in the economy remains at a higher level than it's been in a while. So what can I tell you?
Yeah, Bloomberg came out. Stocks hit new high. This is why stocks hit new high while debt risk premiums shrink to multi-decade low. That's exactly what's going on, guys. Bloomberg is putting stock market and credit spreads right next to each other, so you can see the divergent view, the inverse relationship.
This is why this show is not financial advice.
I had that house stock. I had it, for those that know, and I don't even want to talk about it. All right, anyway.
You're also the insider.
I blew it. I still feel like we can come in. I still feel like we can come into here. It feels melty uppy. This market feels melty uppy. This is the most hated rally ever. Nobody believes it. This keeps going higher, and I think it can until it doesn't. So we'll see what happens. Meanwhile, there's some inflation over here. There's monitoring this, the jobs market over there. Some people look at leading indicators. This is Macro Monday. Leading indicators, stuff like lumber. People look at lumber as a leading indicator because if the home buyers are not ordering lumber, then maybe not building, stuff like that. They also look at shipments. And financial Twitter goes over this kind of stuff and basically saying, you know what, just as John said, there's some stuff out there that is showing some weakness. And this is one of them. Typically, this is a good indicator, guys, this freight index. But I don't know. We'll see whether or not this turns into something.
I know. So it's, you think about all of the news that we've experienced over the last few months, and it's a lot of the old world sentiment is being completely reordered, right? There's like a new world order kind of thing. And you think about the shakeup at the Bureau of Labor Statistics, and it's like, well, can you rely on these numbers anymore? Like, well, what's happening there? And then now you think about the freight index, right? The world we're in, in which tariffs now exist sort of front and center, is not the same world as 2020. It's not the same world as the GFC, the Great Financial Crisis. So I can't tell if this chart is a forewarning of things to come, or if this is a reaction to things that have happened. So again, time's going to tell on this, but it's definitely, we're going to have to start looking for different indicators. And it's going to be a while before those sort of coalesce.
Yeah, that's an interesting thought, right? The playbook that we've known for the last 30, 40 years might be different, and we should keep an eye open for that. It might be a different world. Interesting, John. Let's shift to rates, guys. Rates. The Fed cut their rates, guys. You knew this. We do this every single Monday. This table is the Fed Fund Futures. It says so right over there. Okay, you guys can do this yourself. We're at the Fed Watch tool. Okay, let's just tell you what you need to know now that the Fed already cut rates, and then we'll show you what mortgage rates did after the Fed cut rates. All right. First off, we're here now, right? We were up in this level, but they cut rates. So now we're down at this level, 400 to 425. Okay. Their next meeting date is October 29th. There's still a 90% chance of another quarter point cut, one more cut in October. And then December, you got 75% chance of another cut. So the markets are still pricing in two more cuts, Johnny, October and December. Priced in. Okay. Now, what I want to point out is, where's my mortgage rate chart? Okay, guys. What I want to point out is, everyone's asking, all right, when they cut rates, rates are going to go even further down. I'm like, no, it's because it's already priced in. So they cut rates, and look what happened. Look at the reaction. Guys, rates went up. So I want you guys to understand. We talk about it on this show a lot. Stock market, the mortgage market, the Fed Fund Futures, all these markets are future discounting mechanisms. I don't know how else to describe it, right? Imperfect future discounting mechanisms. And every day information's coming in and they're adjusting their expectations for the future. They don't care about now. They care about the future. We call that priced in. Right. So when the Fed went ahead and cut their rates, something changed and mortgage rates actually reacted slightly the other way and went up. Yeah. That's what we're talking about.
One of the things that we should be, I always think we should be, folding this into the conversation is the yield curve. And just, you can see as the duration of the yields of the treasuries and the T-bills, T-notes, et cetera, as you go out in time, they form a curve. And so when the Fed dropped its rate, the front end of that curve, the overnight dropped, but the 10-year, which is kind of what treasuries generally price off, actually has increased over that last week or so. So that's why you're seeing that little tick up. But still, I mean, to your point, Noah, if you draw a trend line, just kind of get a sense of the direction of these. Yes, it's come back up off of its recent lows, but it hasn't quite gone up so far that you say, all right, well, that downtrend is done. So I still think we're in a downtrend. I still think we might have a little bit more room to run to the downside on mortgage rates, which I love it. I'll take it every day because I would love to get some more of the non-luxury units into contract in this market. So let's hope that continues.
Well, it's a big move. I mean, we were a few months ago, we were up here, and now we're down here. So that's a notable move. And it all goes back to this table where the market went from expecting one cut to 3 cuts. And we got one of the 3 cuts. So we got 2 more cuts left that the market expects. And that's October and December, guys. Remember what I told you about this table. You got to be careful. Okay. Number 1, don't go farther than a couple of meetings. Don't go far. Just look at the next couple of meetings. This is already 3 months out. Okay. Who the hell knows what the hell all this stuff is going to be? It's too far.
Yeah.
Okay.
Just let me say, sanity check. Yeah. I think they made this table bigger because when I first opened this up this morning, I was like, good Lord,
right?
That's a lot of boxes. Has it always been like out to 2020s? Is it always been this big?
No.
It's more, right?
No, I think it went to there and now it's going to there. I don't know. It's going a lot more out. But anyway, don't go
cut it out.
Yeah, cut it out. Don't go farther than the first 2 months, a couple of meetings, excuse me. And secondly, guys, look at the percentages of the ones that I'm telling you about, and then look at the percentages of the ones that I'm not telling you about. And do you notice anything? Right? 75%, 89%. All right, those are high enough. 90%, okay, we're probably going to get it. 75%, I'm pretty sure. Right? Could change. But 43%, 33%, too far out, too low. I have no idea what's going to happen.
Yeah, and that's why you'll find that this is pretty much 50-50 all the way down going out to 2027 because people have no idea. It's just like,
yeah,
I don't know. Something's going to happen, but I don't know what it is.
If you want to visualize this a different way of what the markets are expecting, that's how you say this. This is what it looks like, guys. This is what the market expectations are for the Fed funds rate over that period of time. So you can see this is priced in. This is priced in. So if something changes tomorrow and all of these numbers start to go higher, right? And this curve goes like that. Well, hold on. Let me take this out and do it again. And this curve all of a sudden goes like that instead of like that, mortgage rates going up. Right. In order for mortgage rates to go down, this needs to go even lower than where the blue line is now for mortgage rates to go down. This is what I call priced in. This is what the markets expect. That's your new benchmark. Yeah.
And that is why we like to look at the pricing probabilities table because it has all of those probabilities there. And so the first thing you're going to see is not necessarily the shaded boxes, but the white boxes with the less one. You'll start to see those expanding to one side. You start getting the sense that, okay, we're starting to get a little bit of movement here. So those are going to move before the other ones move typically. So that's why we like to keep an eye on this and dive into the matrix. Yeah.
All right. So mortgage rates, I mean, we're entering fall at a great time with mortgage rates. We're entering time. So hopefully some buyers that leveraging this right over here. You did bring up the inflation, Johnny. You did find this chart that core inflation probably decelerated in August. Again, you have this, it's really confusing. I mean, you got these mixed signals on inflation. It's come down a lot, but it's still a little above the target. And then you got this mixed signals in the labor market. And then you got shipments going down and lumber going. It's strange.
It is strange. And I'll just say, whatever the data of this chart says and whatever kind of cool colors they use, which they do a good job with their colors at Bloomberg.
It's pink and
when
black.
Bloomberg puts the word probably in their chart headlines, like core inflation probably decelerated in August, something is happening. So again, there's just a lot of uncertainty remains. I think the chart title encompasses that all-encompassing probability of that we don't quite know just yet what's happening. But still, this does focus, you think about the Fed's dual mandate, right? High unemployment, low inflation. So this does kind of shift, it further cement the idea that the Fed's going to be fighting low and high unemployment. They want to boost employment, get the economy back on track versus trying to tamp down on inflation by raising rates. So it's a little bit more weight on that end of the scale.
Yeah, that's interesting that you say that. I agree. I think the Fed's going to favor the economy over the inflation, almost sacrifice a little inflation to get the economy going a little more. Interesting thing going on. I now want to just shift it to
I don't know.
Shift.
That's a new one.
Shift and pivot.
Yeah, shift it.
Anyway,
that sounds like a golf swear word. Oh,
yeah,
I
should be.
That
this is national housing construction. All right. I like to keep you guys. I like to do 1 or 2 of these every Macro Monday because we are in real estate. Sometimes you have investors, people outside Manhattan saying, why Manhattan? It's good to have a general understanding of what's going on outside. From what I see outside, take a look at the orange line. That is building permits. building permits, private housing building permits, right? And then the blue one is going to be housing starts. Housing starts. Usually they go together, right? If you're going to start a house, you have to permit it first. So they're going to go together. But they're both going down. They're both going down. So it's not like we have any excess going on here. And when I look at total multifamily units under construction, again, this is being built by the big builders. It's going down. So you know that the country is going through something. The country is going through something on an aggregate level that our market is probably not experiencing. This is one of the reasons why I think the housing downturn is going to be very different, because the inventory shift different.
It is. But so when I look at this chart, just the two things that pop out is we have some dips, right? So we have some, great financial crisis dips, 2008 to 2012 or so. And then there's a peak, right? The post-COVID crazy boom peak. But if you take those out and you just kind of draw that line, like it kind of follows that curve, we're kind of close to where we are, if not maybe a little bit below. And the idea is that there's a long-term trend underneath all of this data. As the country grows, as it prospers, you want to kind of keep building homes at a steady rate. So obviously sometimes you're going to be below that rate. Sometimes you'll be above the rate, but we may be close. So yes, it has certainly decelerated over the last few years, but we may be, especially with mortgage rates we are now, we may be getting back to that neutral point where, building may commence again. We'll see.
Yeah, we'll see what happens. But yeah, look at talking about building. Lennar is one of those big builders. There's a couple of them, and this is taking into account their average selling price net of incentives. It's like almost like net effective rent, right? You think about rent, $5,000 a week. They give you 3 months free. All right, your net effective is $4,100 without all that, kind of thing. This is what they're doing. They're before they lower the prices, they're going to give away a lot of incentives. Well, if you calculate that, like OPs for housing, for housing, new housing, they're down 22%. It's like, oh my God. Like, could you imagine if Manhattan was down 22%? Like, we're not, but that's like a big move.
Yeah. Well, I mean, when was the peak? When are we now? And so mortgage rates have gone up more than 20% in that time. So the affordability has increased by, more than the cost, I suppose, has increased by pretty much that or more. So they're bringing basically in line with historical costs. And it makes a lot of sense, but hopefully, again, you kind of get to that baseline, and with interest rates going the way they are, I mean, we might start to see a national turnaround. I'm going to keep my fingers crossed for that, Noah, but
we'll see.
I think we're getting close.
We'll see. It's interesting that Manhattan, Manhattan didn't do anything during this whole time, like 10 years. It's done nothing. The housing market has done crazy things over the last decade, and Manhattan has not. I'm really interested to see at some point when Manhattan does get going, whatever that is, what that shape is going to look like. I think it's going to be really interesting. And pivoting back to Manhattan, okay, we try to do that. We pivot back to Manhattan, get out of those charts nationwide and look at the charts Manhattan-wide. Mm-hmm. We did a little data digging. Want to give you guys a little look-see, okay? What this chart is, let's say you're a buyer, okay, and you sign a contract in each month of the calendar year, okay? Well, we looked at averages for listing discount to original asking price. When it's a high number, that means it's better for buyers. When it's a low number, that means it's better for sellers, okay? And it shouldn't shock anyone to see that if you signed in September, 5.29% is the discount that buyers got. It goes down a little bit in October, up a little, but down from September and November. December and January are the 2 months for buyers that really want to focus on value. December and January. On the flip side, April, May, June are the best months for sellers. But I thought this was interesting to see how the calendar year and deal activity correlate with each other for seasonality purposes, basically.
Yeah, there's almost a negative correlation between contract sign volume and discounts. So as contract sign volume rises, discounts fall. And the idea is that obviously there's more competition among buyers, so you get less discounts heading into the busier months. And it was Realtor.com, I think, that put out an article recently saying that October is the best time. They actually specified the dates, like October 12th to 18th is the best time to buy a house. That's when the buyers have the most traction in the fall. So look, that's a national headline, and I think I've made my feelings on national real estate headlines pretty clear, which is that, with that and 25 cents, you still can't get a cup of coffee. But either way, it's interesting to know that there is a little bit of traction out there, and the idea, and you can see it here, it's a little bit of a dip, right, in that discount, and that's the sense that there is a little bit of little bit of traction for sellers in October. And I think what realtor is getting at is that the fall month really condenses around October. That's the time when buyers are out and they have. Yeah.
Mm-hmm.
So
that's
let's
the
hope
discovery
that on the
moment.
market. Let's hope you get the buyers, and let's hope some contract signs follow through, and we start to be able to count them once we get into October and November.
Yeah, that's the time you got to be listening in October. That's what you got to tell your seller. We got to listen to what the market says during October, and if the market's not reacting, at that new price, you got to listen to what the market's saying, and you got to come closer to the market. It's as simple as that, guys. And I want to show you one more little weapon, chart weapon, data weapon, whatever you want to call it, of what you could show your clients. I call it pricing penalty. We do this every once in a while, but basically this looks at 2 data sets, guys, 2 data sets only. It's quite simple once you understand it. Let's take a look at that bottom gray line. We look at all the closings that took less than 60 days. Less than 60 days. So let's just call them price right. They sold quickly, 60 days, contract signed. What is the listing discount? 2%. 2% listing discount. And then we looked at all the properties that took more than 4 months, 120 days or more, 4 months to trade. What is that listing discount? It's 10%. So these are things we know. We know of this. If you're on the market longer, it's going to take you longer to sell. You're going to lower your price. You have to negotiate more, right? If you price right, the market should react. You'll get a quick deal, negotiate less. We know these things. Sellers don't think this way. Sellers think, well, if I don't try, I'm not going to know, right? So let's try 10% higher. And that's the biggest mistake you can make, is by aspirationally pricing in a challenging, one second, guys, wait for it, in a challenging listing climate. You can't do that, right? So show them this, scare them straight, and listen to what the market's saying, because you don't want to be one of those 10% statistics. Somebody is asking if we have a similar listing discount chart for Brooklyn. We do. All you got to do is click on Brooklyn right here, generate the chart. It might take a little while to load that data set up, but let's take a look. It's 0%. 0% for the 60 days and under. You're basically getting full ask, and it's 7% for that priced wrong sector. Okay, guys, you can download this right here.
Yeah.
Have this conversation before you list. Go ahead.
And so what's interesting is this is I think the bottom line is what, less than 60 days on the market, which is pretty phenomenal for Brooklyn. And what's crazy is when you look at it, I remember when you developed this, when you look at it with 30 days or less, and you had a contract signed in Brooklyn for less than 30 days, it was negative. And it was negative for like a swath of period of time, which meant that you're getting on a median over the asking price. So I don't know if those days still exist in Brooklyn. I don't know if we're quite there yet. I think the Brooklyn market is waiting for some low interest rates. I think it's waiting to get restarted again. But still, that demand for Brooklyn is, as the kids say, off the hook, and it's still there.
Yeah. Let's do a quick summary, guys. Let's do a quick summary of everything we're talking about right over here. We'll start with Manhattan, guys. First off, optimal time to list. This is it. Pull forward listings that are going to list a month or two from now. Bring it forward, okay? Because your seasonality is going to go against you. Let them know there's a reason for it. The listing climate, it's still challenging. Got to be careful, guys. You can't be aspirational in this market. It's still a tough market for sellers. Pricing penalty, we just went over that, guys. Hopefully you know how to use that chart and have a good conversation. From a weekly standpoint and from a monthly standpoint, I see supply coming on a little heavier than normal. And so far, I see demand a little lighter than normal. Supply a little heavier, demand a little lighter. That's probably contributing to the challenging market. From credit spreads perspective, risk on in the markets. Don't be surprised to see stocks and other risk assets just continue to risk on. I mean, I don't see any warning sign here. From a Fed perspective, okay, with rates, one more quarter point cut in October, one more quarter point cut in December. After that, it's too wishy-washy to even give you guys advice. Okay. And we circled back on Manhattan, and you know what's going on there. We're going to stop right there. Ask you guys if you have any final questions.
Yeah.
Anyone? Bueller. Tomorrow we got the property pricing report wizard. So if any of you guys want to know how to use this technology right here, generate a pricing report, right? This property pricing wizard, we'll talk about it tomorrow at 11 o'clock. All right. You can always sign up for a free trial and test it out. Other than that, that's all I got.
Or if you don't want to have to price it yourselves, you can try our UrbanDigs Advisor service and let us help you price it for you. Like we do a deep dive and do the thing.
Shameless plug. We got a question here.
Shameless plug.
In a market
Okay.
where discounts are the norm, Johnny, in a market where discounts are the norm, is it better to price with a built-in negotiation buffer or to price aggressively at the target number from start? I know my answer.
That is a fantastic question. I love questions like this, and I have my thoughts too. You want to go first?
So go ahead.
I think we're probably I would say I would price aggressively from the start. Look, the goal is buy-side competition.
Price aggressively
the most buyers competing with each other, and if you price aggressively, you get an open house and it's cheek to jowl, and people are like, oh my god, this thing is a steal. That's when you're going to drive prices up. So that's when you're actually letting the market work. When you're pricing with that negotiation buffer, you're basically culling the herd of buyers prematurely. So that's my thinking on that. And the other thing is, it's kind of hard to know what that negotiation buffer is unless you've really pinpointed the price and done your homework there. It can get a little bit tricky. And one of the things that we've also done research on is, we have a chart somewhere. I think we maybe talked about it on one of our.
Well, I'm drawing over here.
The idea is that there's an inside market for every unit, and you take where buyers expect that price to be, and it's just a general expectation. And if you're beyond that by like even 10%, once you start getting like 12, 15%, it's just going to be crickets. Like, just people are going to they're not even going to bother showing up. So it's really, really tricky when you start thinking about that negotiation buffer, because if you go too high, you're just going to, cut yourself off at the knees. Sorry for that horrible metaphor, but
no, it's all right. So. Let me visualize what John just said. Look at this chart I'm drawing down here. Okay, guys, the bottom is time. Okay, 0 days on the market over here, 180 days on the market over there. Okay, this is what you have to explain to your client when you answer this question. Traffic is on the left. Traffic's on the left. Low traffic on the bottom, high traffic on the top. Time on the bottom. When day one comes, you're up here. You get the most of day 1, day 2, day 3, day 7, day 8, day 9. It takes the buyers out there a good 7 to 10 days to discover your property. So the first couple of weeks on the market is your highest traffic total, right? Once you get to day 30, give or take, your traffic is going to go down. It's going to look like this. This is what the curve looks like. So if you price high on day 1 and you alienate the market by pricing high, you're going to blow this first 14 to 28 days, which is the urgency period.
Don't do
right? It. You're going to blow it. And now you're going to be cutting your price on day 40, day 60, day 90 in a lower environment, trying to catch the market. So it's risky. You do that in an easy listing climate, high volume, easy listing climate, seller's market. All this stuff can be found on UrbanDigs, right? If you go to the chart, let me get rid of this. You go to the chart room, okay? You have listing climate over here, you have liquidity over here, and you have market pulse over here. Challenging listing climate, low liquidity, higher buyers or sellers market, right? When those all align, then you can get away with that strategy. Otherwise, don't do
it. Fantastic point. No, the other thing I would add to that is, when listings hit the market, the buyers whose search filters it's triggering, and they're getting the emails and looking at it, they have been on the market for a long time. They know every single thing in this market, probably better than you do, and definitely better than your seller. They are intimately familiar with everything in this market. So if it's not ringing bells immediately in them, like, you're already starting off on the back foot. So just to your point, no, you're going to miss those views. You're going to have to cut the price. And again, price aggressively from the start.
If you're forced to do the high price because that's what the seller demands, right? At least have a plan B in place on how long you're going to be at that first price. When are you going to discuss lowering that price, and what you're going to discuss lowering that price to, and at what point? And you can find all the data on UrbanDigs to help you, guide you on that conversation there, right? If it doesn't work, if that high price doesn't work in 2-3 weeks, you got to amend. And use that word amend, price amendment. It's better than price discount. Discount and reduction are like negatively
adjustment, amendment. Yeah, good stuff. Neutral language.
Use something that's a little more neutral. It might just ease the pain. We just discussed this. There's a whole thing right here. Price reduction strategies. We went 30 minutes on discussing the psychology of sellers. At the end of the day, guys, it's crazy. You got to get that seller from denial to acceptance. And in between denial and acceptance is anger, bargaining, and depression. And if you ever experience a seller getting pissed at you, well, you're not doing your job. Right? You're going to get more market, more open houses. They get pissed at you. That's them going from denial to acceptance. And by having these conversations and showing them that there's others doing it in the market and the average price cut is 7%, let's try to get below it, blah, 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 right? It'll help them get to acceptance quicker at the end of the day. It's a process. All right. Good stuff, guys. Good stuff.
Yeah.
John, thank you very much. All right. You're the best. Don't
Pleasure.
stop being who you are. Guys, that is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs. Thank you guys so much for joining. This has been Macro Monday. We'll catch you guys next time.
Thanks, everybody.
Cheers, everyone.